Investing can often seem like a labyrinthine pursuit, filled with complex terms and myriad options. Among the most common and important investment choices are indices and mutual funds. Indices or index funds are collections of stocks or bonds that aim to mimic the performance of a specific market index, such as the S&P 500 or the Nasdaq. By investing in an index fund, an investor essentially buys a small piece of each of the companies included in the index. On the other hand, mutual funds are pooled investments managed by financial professionals who allocate the fund's capital into various stocks, bonds, or other assets. Unlike indices, mutual funds are actively managed, meaning that the goal is to outperform the market rather than simply matching it. The following sections will delve deeper into each option, helping you to understand their nuances and guiding you towards making a choice that aligns with your investment objectives. Indices are designed to track the performance of a specific basket of stocks or bonds. For example, the S&P 500 index tracks the stock performance of 500 large companies listed on stock exchanges in the United States. By investing in an index fund, you're essentially betting on the overall performance of these companies. One of the primary benefits of investing in indices is cost efficiency. Index funds typically have lower management fees because they are less labor-intensive to run. This lower cost is a significant advantage for investors, as high fees can eat into long-term investment returns. Another advantage of index investing is transparency. Investors know exactly which assets are in the fund because it mirrors the composition of an index. Furthermore, indices provide broad market exposure, which helps in diversifying investment risks. Mutual funds collect money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. Managed by financial experts, these funds aim to achieve higher returns than indices by actively selecting and managing investments based on extensive research and market analysis. The active management aspect of mutual funds is both a potential benefit and a risk. Fund managers use their expertise to try to outperform the market, which can lead to higher returns. However, the success of the fund heavily depends on the manager's skill and market conditions, which introduces a layer of uncertainty that does not exist with passive index funds. Moreover, mutual funds offer a variety of investment options, catering to different risk tolerances and investment goals. This variety allows investors to tailor their investment strategy more closely to their personal financial goals. While indices and mutual funds both serve as popular investment vehicles, they differ significantly in terms of management style, cost, and investment objectives. Understanding these differences is crucial for any investor before making a decision on where to invest their money. The most striking difference is the management style. Index funds are characterized by a passive management approach. They simply replicate the performance of a predefined market index, which requires minimal buying and selling of stocks. This passive nature results in lower transaction costs and management fees. In contrast, mutual funds are actively managed, requiring a hands-on approach from fund managers who make regular investment decisions in an effort to outperform their benchmark indices. This active management in mutual funds typically results in higher fees. While these fees are in place to compensate managers for their expertise and effort, they also reduce the investor's net returns, especially in scenarios where the fund does not significantly outperform the market. Index funds offer simplicity and are best suited for investors looking for market exposure with lower costs and lower risk. When it comes to investing, understanding the fee structures associated with different investment vehicles is crucial. Fees can greatly impact your overall returns, especially over long periods. Index funds are renowned for their low-cost structure. Because they are passively managed, they do not incur the same operational costs as actively managed funds. The typical expense ratio for index funds ranges from 0.02% to 0.15%. These low fees are a significant draw for investors, particularly those who are investing large sums of money over long periods. Mutual funds, in contrast, have higher expense ratios due to their active management. These ratios can range from 0.5% to over 2%, depending on the fund's investment strategy and the management team's expertise. The impact of these fees becomes more apparent over time. When choosing between indices and mutual funds, potential returns are a key consideration. Each type of investment offers different prospects for earnings, influenced by their management strategies and market behaviors. Index funds typically provide returns that mirror the performance of the underlying index. For instance, if the S&P 500 index grows by 10% in a year, an S&P 500 index fund will aim to deliver a similar return, minus any fees. This predictability is one of the hallmarks of index investing. Mutual funds, however, aim to exceed the returns of the market indices they might otherwise be compared to. This means that in a good market, well-managed mutual funds can provide significant gains over and above the market performance. However, the flip side is also true. In a bad market, or if the fund is poorly managed, it can underperform relative to the market, sometimes significantly so. The potential for higher returns in mutual funds carries with it higher risks, including the risk of losing principal, which may not be suitable for all investors. Section 7. Risk factors. Evaluating safety and volatility. Investing always involves some degree of risk, but the level of risk varies between different types of investment vehicles. Indices and mutual funds, with their distinct management styles and investment strategies, also differ in their risk profiles. Understanding these risks is vital for making informed investment decisions that align with your risk tolerance. Index funds are generally considered to be lower risk compared to mutual funds. This is because they diversify investments across all the companies included in an index, mitigating the impact of poor performance by any single company. Additionally, the passive management style of index funds avoids the risks associated with the potentially erroneous trading decisions that can occur in active management. Mutual funds, while potentially offering higher returns, also come with higher risks. The active management approach can lead to significant gains if the market conditions are favorable and the fund manager's decisions are sound. However, this same active management can also result in substantial losses if the decisions do not pan out as expected. Section 8. Why choose an index? For many investors, index funds present an attractive option due to their simplicity, lower costs, and transparency. Here are several reasons why one might choose to invest in an index fund over other types of investment vehicles. Firstly, the low cost of index funds is a major advantage. Because they are passively managed, the fees associated with index funds are significantly lower than those of actively managed mutual funds. This means that more of your investment goes towards growing your wealth, rather than paying fund managers. Secondly, index funds offer a high level of diversification. By mimicking the performance of an index, these funds invest in a broad range of companies across various sectors and geographical areas. This diversification helps to spread risk, making index funds a safer investment compared to putting all your money into individual stocks or less diversified funds. Section 9. Why opt for mutual funds? While index funds offer many benefits, mutual funds are not without their own unique advantages. For investors looking for potential higher returns, and who are comfortable with a higher risk level, mutual funds might be the more suitable choice. Here's why one might opt for mutual funds over index funds. Firstly, the potential for higher returns is a significant draw. Active management can capitalize on market trends and investment opportunities that passive strategies might miss. Skilled fund managers can navigate market fluctuations and potentially enhance returns through strategic buying and selling of assets. Moreover, mutual funds offer a variety of choices that can cater to different investment goals and risk tolerances. Whether you're looking for income, growth, or a balance of both, there's likely a mutual fund that matches your needs. This customization is something that passive index funds generally cannot offer. Section 10. Making the right investment choice. Choosing between index funds and mutual funds is not merely about comparing potential returns or fees. It involves considering your own financial goals, risk tolerance, and investment horizon. Both types of funds have their place in the world of investing, and the right choice depends on individual circumstances and preferences. If you value simplicity, lower costs, and lower risk, index funds may be the better choice. They offer a straightforward approach to investing that can be ideal for both beginners and seasoned investors looking for dependable, long-term growth without active involvement. On the other hand, if you are seeking potentially higher returns and are comfortable with the associated higher risks and costs, mutual funds could be more appropriate. In conclusion, educate yourself, consider your options carefully, and if necessary, consult with a financial advisor to help guide your decision.